You're listening to Withum's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Withum's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Welcome to a podcast with Withum. This is a tax podcast, but today's episode will be around accounting and tax issues that we see primarily in the restaurant industry. And so with me, I have Jared Feldman, who I've known for 11 to 12 years now. I let him introduce himself, but we work with mutual clients in the restaurant industry, mainly California, some Hawaii, amongst other places. So I'll let Jared introduce himself. I'll do a little intro, and then we're going to dive into some topics that may be of interest within the restaurant industry.
Well, thanks so much for having me, Derek. My name is Jared Feldman. I've worked in restaurant finance and operations for 12 years now. And over those years, I've learned a lot of the fun nuances with it that you've helped me with as well.
Yeah, so I'm glad you're here. So we met when Jared was a client of mine, and then he started his own business, and that's where we do a lot of mutual client work. And so my name is Derek. I'm a principal, do primarily tax work within the food and beverage industries, amongst others. And today will be, like I said, a conversation around some of the things that we're seeing at our clients' pain points around accounting, tax, etc. And so one of the first things that always is a fun one to talk about are investors. And so I know that when it comes to fundraising versus loans, Jared, kind of what do you see with respect to this within our client groups?
I think it really depends on your level of risk and your level of confidence. I have this conversation too often, but frankly, it's if you're pessimistic or conservative, you should go with investors. If you're optimistic, you should go with getting a loan. Now, granted, 6 or 1/2 dozen, they are not. With an investor, you don't have to pay them back any money right away. Whereas with a loan, that clock's going to start ticking, and you might have a $5,000 or a $10,000 payment that starts immediately. But for clients that are trying to do a smaller raise, I would say $500,000 or less, which is personally what I think is the best way to open food service, is less is more. Even if you only get, say, 80% of the way of what you want, but you spent way less money. Long story short, you can make a manageable payment on that loan, and if you're successful and pay it off, all the profits are yours. Whereas with investors, obviously you want to be successful. You don't want to lose anyone's money, but if you do, you're not on the hook like you would with a loan. But on the flip side, if you're successful, you're then going to give up a lot of those future profits to your investors forever.
Yeah, there's some good content in there when you think about it. So loans, you have a creditor situation, right? Your balance sheet shows liabilities, that can hinder you in the future if you're looking for new investors or trying to sell. They'll be like, well, what are these loans on the books? Fundraising, friends and family is the typical beginning of your life cycle in the restaurant industry. And the success stories I see start there, and then it's expensive to buy the small investors out once you actually have a brand, product, service that actually hits well. And thinking of a client of mine where they probably have like 20 friends and family, and they all own like 1% to 3%, but it's expensive now to buy them out, and so there's dilution there. So it's not as straightforward as just thinking, well, do I pay them back or not? It's like now I have to think about what happens when I have high growth, high value. There also are hybrid investments. I don't know if you've seen this a lot, Jared, but there's a hybrid investments like safe notes, convertible notes, where it depends, where if it's an actual equity or not, there might be triggering mechanisms. And so safe notes are a kind of a newer hybrid investment where it might say, well, if you hit $1 million valuation as an example, then they trigger into equity. And so now you have future ramifications of that. I think some of the things that I want to bring up around the loans is actually treating them like bona fide debt, right? So some components that you see with debt, maybe the interest probably are the big ones.
I mean, the interest, and even more, frankly, I mean, it's an expense. It goes to your P&L, it goes to your income statement. But for restaurants that are at best case off the bat 5% profitable, that principal payment you have on that loan might be where your cash flow then is negative, and then you're scraping by. So that's kind of the difficulty. And naturally, anyone puts
Mm.
together a pro forma, they want to be making 15 or 20% off the bat. In reality, you're going to make half that off the bat if you're doing well. And so it's really a balance. Now, I would say 5 years ago, 4 years ago, it was a big difference. I have two different clients, for example, right now that took out roughly $1 million loans to open businesses. One did it in 2021, one did it in 2023. The interest rate difference between those two is about 9 points. One is two and
Mm.
a half, and one is 11 and a half. And that's where, if you don't have fixed interest rates, if it's SBA, that's a huge amount. One person's payment is $2,000 as interest. The other person's is $12,000 as interest. And that, luckily, both of them are succeeding. So the cash
Yeah.
flow is okay. But with fine margins, that's really the scary part, I would say, about getting those loans.
Yeah.
Without going into a personal big diatribe here, like I said before, lesser raise the better. Do it for 500,000 instead of $1 million, instead of 2 million. If you need to be above $1 million, you probably need to go get investors in some manner, or some sort of exotic safe investment convertible note. Because if you could even qualify for that loan, which kudos to you if you could, those payments are going to be really arduous.
Yeah. So something to segue away from the fundraise versus loan for a minute is the term you use about profit margin. So in your experience with clients on the accounting side, when you're looking at a healthy restaurant, like what is some of their margins that you're seeing that would kind of start to indicate to them, maybe we're starting to show some health, irrespective of like having to pay back investors and maybe loan payments, etc.
Yeah, I mean, from a pure bottom line EBITDA, you want to be at least at 10%. But frankly, that's, holding on for dear life. That's white knuckling, especially if you're a small, your average restaurant that I see is it's self-funded, or it's friends and family, or it's friends and family plus an SBA loan. Your goal is $2 million in income a year. If you can make 200 grand in profit, that's great. And that's a good starting point. But that's also $200,000 is a lot of money. But at the same time, those are still razor thin margins. So if you can be
Mm.
above that consistently, I think that's where you're like, hey, we're doing okay. Maybe we take half of that and start paying back investors. And if you had $300,000-$400,000 investors, you could make that over 3 or 4 years. You could pay them back in full. It's just, if you're 3x that and you need to be paying back $2 million of investment, that's going to be a long road to hoe kind of thing.
Yeah. That's a good one, because I think we see that with our restaurants is you hear about these razor thin margins when it comes to costs of everything. How everyone says, well, raise your prices. Well, you can't
Right.
just have that as the default, because when you say, well, I made 200,000, most people will say, well, that sounds great.
Right.
But then I say, well, I have 2 million of gross revenue. Well, that's a lot of expenses to get through before you hit. That's, your tax fees, your accounting fees, that includes payroll, all sorts of stuff, utilities. I mean, your biggest costs are food, obviously, and then rent,
And
which
labor.
we'll talk about, and labor, which we'll talk about later. But with respect to that, I think I would probably agree that most of the successful restaurants, we'll call them, are 10, 11, 12, at a minimum. 13 to 15 is getting to a point where, if, that's likely they're having revenue much higher so that they can absorb some of these other, fixed costs. But I think one of the things that I also see, and this is not necessarily in accounting, it's also operational, but I don't know, Jared, if you comment on this too, is people looking at their capacity in their restaurants. And so I think some of the better restaurateurs look at their potential capacity and build up to that to be able to manage it. So as an example, like a pizza company might say, if we look at the amount of space we have with our equipment, we could probably get 4 to 5 million. They're not thinking that way. Usually they're probably just like, obviously their pants just hoping for the best, right? So I think with respect to clients you work with, like how do they approach some of that in terms of the planning?
I mean, I think you have to build out your pro forma as you are not going to be 100% full all the time. I mean, the
Mhm.
standard issue restaurants open 5 days a week with one crew that works every, let's just say 5 nights a week, that the same people work every night. Your Saturday is going to be super busy. That's great. That's going to be your full capacity if you can do it. You're never going to do that on a Tuesday. So, how do you build out where it's like if we are making 75% of our capacity, let's say 60%, 60%, 60% Tuesday through Thursday, and then 100% Saturday and, excuse me, Friday and Saturday, and then let's pretend that that's 75% capacity. That means you have room to grow, but also you're not relying on being gangbusters right off the bat every day. And if you don't, you go out of business. And I think a related thing, which we can go into more later if you want, is the scalability of labor. Because you need your
Mhm.
full team on a Saturday and a Friday where you're doing 100%. But if you still need your full team on a day you're doing 60%, then you're losing a lot more money than just, lack of having people in the door. You're spending full labor to get 60% sales.
Yeah. I think it's an important concept to understand, and this is, has some accounting, but also finance operations to it. Is the capacity issue. If you can understand, your top capacity and work down from that, then you can start to plan accordingly with respect to that. So that's a pretty, important concept. And sticking with that in a related manner goes to back to this fundraising versus loans is build outs. And so if we look at a one unit restaurant that finds success and they're ambitious to go to the next group of units, 2 to 5 units, let's say, which is probably a really good example. The question is, what are you seeing with respect to restaurants in terms of how they fund that?
And I mean, in a perfect world, you self-fund in a manner where you have enough success from the first restaurant that you can build up some cash, and then you can maybe go get a loan, or you can get small amounts of investment to go do the second one. And I think this kind of plays into what we talked about before with loan versus equity, but I think that, excuse me, loan versus investment, but it all comes out to, can you do your build out for a reasonable amount? And if you did the first one, can you do the second one for the same amount, of adjusting for inflation or whatnot? Where I see people go really in trouble is where they did a big build out, they're still paying it back. They've had some operational success for their restaurant,
Mm-hmm.
but they haven't really, let's say, become fully cash flow positive. And then they go and double down and open another one and do the same build out style again. And then you've actually gotten yourself into more debt, even though operationally you might be profitable and this new restaurant might be profitable. So I think in order to start on the right foot, you need to make sure that you are not necessarily fully paid off, but you have the cash to cover your startup expenses. I've
Yeah.
seen multiple times where you're scraping to get by. Of course, construction always costs more than you're expecting. Then you have a targeted opening date, you don't hit it, and then the debts start rolling in, and then you kind of spiral in on yourself. And so you need to always have construction contingencies. My father worked in construction for 35 years as a builder and designer and developer. You need to have at least a 10% contingency, but given these days, I'd say a 20% contingency. And you really got to have that money in the bank or a reasonable loan lined up to cover those extra costs. Because if you
Yeah.
start behind the 8 ball, it's really hard to catch up.
Yeah. I mean, what I'm seeing is a change of thinking in terms of some of these build outs. I mean, the traditional growth model is you fund your first one, as you're saying, try to create, a brand awareness success. If you have a lot of money behind you, maybe you don't care if it's a lost entity yet, but ideally it's not. And then, assuming you don't have the money just lined up behind you coming in from other investors, then the question is, do I do traditional growth, which is I fund it with cash, loans, or a hybrid of both? But what you're now starting to see with some restaurateurs is saying, look, there are advantages to doing, a traditional build out, which is I own the equipment, I own the leaseholds, I get these big tax deductions at the offset when we actually open the restaurant. But you now are starting to see some restaurateurs go to this place of saying, well, I will forego owning that equipment and owning that. Landlord, you build to my specifications, you own it, but I'll pay you higher rent. So I've saved, $500 million of cash. I'm going to make it up at some point with the rent.
Mm-hmm.
But it's a de facto loan if you think about it. I have to pay higher rent, but I've now just saved cash in some respects. And so you're seeing that more now where usually you have to have a landlord that like knows your brand and they're like, okay, this is going to get off the, we're going to do well with this. But that's something I'm starting to see more of. And so, you have this dual thinking now that's out there. Like, do I do traditional? Do I do this more where the landlord really drives it? But that second scenario, most of the time I have to have a brand that's going to like be known and to a point that people are willing to do that. So that's the new thinking, I think, out there with respect to that. So that comes with its own accounting issues, right? It's more rent-based, expense-based, easy accounting versus, how do I account for a leasehold or a piece of equipment, right? Those kind of things.
But I think that honestly, if you can do that and you can convince a landlord to do that, I think that makes the most sense. Because if you could then still churn out, let's say, 10% profit when you're factoring in higher rent, which effectively is your financing costs or however you want to mentally do the gymnastics, that means you've really kind of figured out the secret sauce. And I could imagine if you're going to go into a high-end mall and open one originally, and then that same owner owns another high-end mall and says, hey, your brand that we already know does well and this one would do well in another, then that would track and you could probably make that deal work. I wouldn't say the issue I see, but most of the brands that I work with are very small. They're 1 to 5 unit. That's where I think it would be harder. And for the more mom and pops that I work with, they might have a general local reputation, but financially they don't really have the reputation other than their 1 or 2 locations. And so that's where I'm always like, look, find a existing food service space that you can put new equipment in, paint, put up some tile, spend a couple $100,000. You do not need to take a raw retail space, even if the landlord's giving you a large TI budget, because you're still going to end up, it's going to take you 18 to 24 months. It's going to be a way bigger buildup than you ever wanted. And unless you need super specialized equipment, you're going to get 90% of the way there for half or a third of the cost.
Yeah. Yeah. So there's definitely interesting thought process behind that. One's cash driven, one's, I'm going to own it. Maybe there's a different way to think about it. But again, it's going to depend a lot about the situation at hand. But we're seeing more people try to go towards that latter route of trying to not be the one who owns the investment, owns the property, right? But again, you usually have to have a pretty good brand name on that.
Because you're not going to be able to cash out that investment, honestly. If you put $1 million in TIs into a location and you leave at some point, whoever the next person is that's coming in, you're not getting $1 million or whatever, even the depreciated value of it would be. It likely would be an asset sale. And then, you're going to get 20 cents on the dollar down the road.
Yeah. So, that while you are using it, you get that profit margin up as high as possible. One of the things that we really struggle with some of our clients is our sales tax, POS issues with respect to that. So I don't know if you have any interesting stories or tidbits that you would tell existing and new restaurateurs, like the pitfalls that we face. And I know we're more California based with some of our clients, but this doesn't just stop with California. I mean, this is pretty across the board. But what would be some of your tips as you've seen some of the restaurants get off the ground floor?
I mean, you just have to record everything. You have to be smart about everything. You have to not think that a service charge is not taxed. There's all the non-taxable rules about cold food and whatnot. But other than that, everything else is basically taxed. Run everything through your point of sale system. I've seen multiple times where, hey, one delivery service is run directly through your POS system, one is not, and then you're not accounting for, is this already counted, is this not? So obviously less is more. The less moving pieces, the less chances you have for mistakes. But be very diligent about all those things. Also, whenever there's a sales tax update, make sure that it's updated everywhere in all of your system, because that's another one where I think April 1st, California just did a bunch of updates for certain counties, not San Francisco, but I believe Napa, Santa Barbara, amongst others, had pretty decent jump ups in sales tax. And if you don't update it everywhere, it's your responsibility as the business owner. It is not any
Yeah.
of your third party services. They almost particularly say we do not control this because we don't want to be held responsible. So your catering, your Easy Cater, your DoorDash, your Uber Eats, your any of these other things that are bringing you sales besides directly, through your POS system, you need to make sure you're updating those as well.
Yeah, that's a really great point. Because again, sales tax for those who are listening that are, starting to get in this business is on you as the entity that withholds and collects and remits the sales tax. I said the word withhold, but I should probably use collect and remit. So a really heinous example was a client who there was a mistake in their POS system and it wasn't caught for months and months. And it came up to the tune of probably $110,000. That's out of your pocket if you get caught, and you didn't have the correct sales tax. And so, you can't, under withholding, under collecting and remitting is bad, because if you get caught, then it's on you as a cash flow item to spend.
Right.
Obviously, sales tax is something that you collect from your customers, and then you're paying for it. On the flip side, obviously, if you over collect, well, then you're probably covered, but that doesn't necessarily look good either if that's habitual, So, I think to Jared's point is you want to have advisor be able to advise on, maybe reviewing your sales tax POS system, kind of seeing what they're tagging as sales tax versus not sales tax. One other area that kind of came out with COVID was restaurants selling to like NGOs, nonprofits. And so just if there are situations like that, you're going to want to make sure that they have, if they're going to push back and say, well, you shouldn't be charging any sales tax because we're a nonprofit, then they need to provide you documentation.
They need the documentation. They can't just say, "Oh, we shouldn't get sales tax," because we'll get the company, the restaurant that's selling to them will get dinged ultimately. And I definitely remember that during COVID, where no one was doing anything wrong, but there was sort of like assumptions on both sides, and then stuff got missed and documentation wasn't there. And like my default is make sure everything in your POS is taxed and then back it off, as opposed to marking everything as untaxed and then clicking it as on, because I would rather over collect than under collect.
Right. So start with your accounting, your accountant, your tax people, just to have them take a look. And if they don't, like our firm, that's what we do. We have a state and local team that knows that. The software services are pretty good, but you still want to just make sure, because that's an area of high risk if you're ever audited. And then you'll find this with a lot of jurisdictions that you kind of get on this like 3-year trend of just there's an audit every 3 years. It kind of happens. And so we always want to be mindful of that with respect to both the tax side of things, but it's also an accounting issue, right? Because the question is, the accountants in the world are going to say, well, in a perfect world, your sales tax is never a P&L item. It's I collect it, I remit it, that's it, I'm done, right? That's all I've done.
It's on and off, and it reconciles every quarter, every month, and every year, roughly.
Yeah, that's correct. So, we've talked about sales tax, we've talked about build outs and loans and, certain investor items. I think one of the things that, we're kind of, post-COVID, I'll call it, we're past the PPP loans, we're past the ERC, so we're kind of like in a world where none of that COVID is kind of cleansed from our system. And so I think kind of like to round this out, like what thinking about the sets of issues that we're dealing with today, or the ones we've talked about, high rent, but any other accounting issues, any other accounting, sticking points that we're seeing that we could talk about to kind of round out our
I mean,
episode here?
I think, there's a lot. Like we said, there's only 10% profits and you're doing good. I think rent is high, but honestly fair. And I don't want to rag on any jurisdictions or any, right to work, and it's not a union thing. But the biggest thing that I see in restaurants is labor. And understandably, people want to be paid a fair wage, which I have no problem with. But that is the hardest thing to balance in the food service industry,
Mm-hmm.
where hey, these people are receiving a fair wage. There's a fair, equitable distribution of tips. That could be an entire other podcast for you, I'm sure. How do you make sure you have enough people? You're taking care of those people, but you're also then not losing your shirt because you're taking care of them. And that ties back into how do you ratchet your labor up and down to where it makes sense for your business and it's not ultimately bankrupting you. In food service, you want to do with sort of the 10% profit. 30% should be your cost of goods, 30% should be your cost of labor, and 30% should be your rent and other costs, and you have 10% profit. Now, realistically, it's more like 65%. It's probably like, it's more like 25% cost of goods, 40% labor, and 25% remainder. The long and the short of it is, especially in California, we have high minimum wages, which are necessary and valuable, but are expensive. Anyone you're going to have on a salary is, of course, going to need enough to live. So that means anyone on a salary in at least San Francisco Bay Area is going to be $80,000 a year, which again is very fair, but it's a very hard balance to dance between. And you have requirements for state and local licensure fees that can be gross receipts, can be very expensive. You have requirements for healthcare from the state and certain local jurisdictions that can be very expensive. It's a lot. And then just making sure that you're paying people to make sure you're being in compliance so that your bookkeeping's done. So I'm sorry, that's kind of a large answer.
Yeah.
I do think, circling back to rent though, it was very high before the pandemic. I think there were some landlords that were very understanding and sort of rewrote leases. There were other ones that deferred rents and now are collecting them back, that it helped at the time, but it's not the greatest thing. And I kind of would hope that anyone that signs a new lease now, there's an understanding that rents won't be as cheap as they were during the pandemic, but they probably shouldn't be as high as they were before. And while rent is a very important expense for a restaurant, that's not your make or break, honestly. Like, obviously $3-4 grand a month is a real number. You don't want to lose that. But if that amount is the difference between you making money or losing money, there's larger issues there.
Yeah,
because
exactly.
if that's $50,000 of profit, an anecdote I like to use is there was always restaurants that they're successful. They had a 10-year lease. Then their landlord wanted to renew and they wanted to double their rent from $5,000 to $10,000, or which was at the end of the first term, and they wanted the beginning of the second term. Yes, that's doubling it, but $10,000 could be market rent. And frankly, that $5,000 increase per month, if that's making you not successful, then you weren't super successful beforehand.
Yeah. No, agreed. I think, rent is a touchy point for a lot of clients, because what we tend to see is that a lot of our restaurants will look at failed restaurant spaces as a way to get cheap rent to begin with, because the landlord's like, well, look, we had this lease in place and, I'll sell it to you for 50 cents on the dollar or 75 cents on the dollar. And clients will jump at that because they'll know for the next 5 or 10 years that they probably would have they will save money now on that, even though they would probably have paid that somewhere else, but they would have a more desirable spot, right? And so for those restaurants that have had issues and rent is an exasperating issue for them, like, that's when we see the failed restaurants helping out the ones that are either expanding or someone new. I have plenty of clients who, going into certain areas around San Francisco, as an example, Ferry Building, Mission Street, other areas where restaurants failed. Now there's a decent spot with a great lease up for sale, and they get into that spot, right? So that's part of it. So I think understanding your rent arrangement. Kind of a general accounting and bookkeeping is that you don't pinch, you don't penny pinch for your accountant and tax people, because you're going to get what you pay for. And especially if you're under audit. And this sounds like a scare tactic a little bit, but both Jared and I can vouch for clients that have messy books because they were cheap, and it becomes a problem where you can't even do your tax filings. Your investors can't rely on the books, and heaven forbid you get audited and have to explain stuff away. You're sitting there I don't know what we did. There could be expenses that are just running through your books. You're I don't know what this is. So some accounting issues that I like to point out, especially with clients that are coming to me, and Jared could vouch for this. We've had a few shared clients where we'll look at the DoorDash, Uber Eats, eatery receivables or payables, and say where should that be, right? You likely should be owed money. Is that been reconciled? Because you haven't reconciled that, you might have money on the table that's yours, or maybe that lends itself to saying, well, is your P&L even correct? So that's one, big area. Obviously, balance sheet items like accrued liabilities, if you have debt on the books but no interest on the books, what are you doing? So things where you're trying to understand the health of your business. It's not about just did I reconcile my cash? That can be done, I won't say by anyone, but that's a pretty basic service that all accounting firms, bookkeepers, accounting firms provide. Obviously that's a big deal, but again, it goes down to, do you know what you're paying? Do you know what you're accruing for a lot of these other items, especially the receivables? Is it money that you're owed that you just haven't collected on? That should be known. Payables, is this money you owe people that you're not aware of, right? Debt on the books. Do you owe people? Jared and I just had a conversation about this a couple hours ago. Are there payments that are just lurking that we don't know about? So those are accounting issues that everyone can get behind. And if you're not able to look at your financial statements, and this is going to be my soapbox, is you need to be looking at your financial statements with your accounting team. So Jared sits with his clients and they go through that process. This is what I would expect from anyone, is they're looking at their financials and have at least a sense of what's in it. And if they don't know, they should be asking, because you should be able to look at your books at a given time and kind of understand the trajectory of where things are. And if you I don't know what that is, my last example will be, there was $1 million account that just says reclass to balance sheet. And it was just what is this? It was just in ins and outs of deposits and other transactions. I'm that's unacceptable. That needs to be looked at. So that's the basic. You need to know your costs, you need to know your margins, but you need to not skimp on your accounting and your tax, because that's going to get you in trouble. You have razor thin margins, but you're going to get what you pay for. And the clients we've had that have had the biggest struggles are the ones that tended to skimp on early on the right people in place. Any other parting thoughts, Jared, before we close down?
No, I think that's a really good point. I mean, I've been doing this since 2014. I've had my own consulting financial company since 2016. I work with probably about a dozen different restaurant groups, small groups, 1 to 5 units. And I still have to have the conversations. Look, you're running a restaurant, you're a manager or a wine person or a chef. No one is asking or expecting you to understand the absolute nuances that we do of the bookkeeping and you do of the very detailed tax laws with depreciations and asset schedules and whatnot. We're not asking that. But there is a baseline level of there's a few basic things you need to be looking at. You need to make sure it's correct with our help, naturally. And I have to have this conversation probably once a month. Just because the bank account looks like it's growing, it does not mean the business is successful. Of course, we want it to be successful, but that's the understanding of your income statement plus your balance sheet. If you got 100 grand in the bank and your balance sheet has $200,000 of liabilities of sales tax and back bills and whatnot, you're not doing well, I don't think, or it's less likely you are. So take the time to understand it on the most baseline level. I like to say with restaurant accounting that it is not complicated, but it is detailed, because there are a lot of simple transactions, but because there's so many, you have to make sure they're going to the right spot. So you don't have to look at it. That's what you're paying us to do. But you do have to have some baseline understanding and appreciation for what we're doing and the value that we do. Because I know that we have this conversation every year at tax time. We always have clients that are trying to negotiate us down because they don't see the immediate value in paying for CPA services once a year. But it's like you're getting that throughout the year. You're getting the support, you're getting the understanding, and you're getting the double check that things are being done right. And you're not going to get hit with a painful audit, 2 years down the road.
Yeah. Yeah, no, that's a good parting thought. Again, we should be able to tell the story of what's happening, and that's part of what I like to say that we do is there's a story behind this, and we need to look at all the components because, again, we're here as, your fans. We're here as, obviously you pay us to do a job, but we're here because you're cheering for your success. And, part of that is growing with you and creating opportunities and advice that will help with that success. So while people think of us as more commodity services, like, no, we provide advice. We're also helping to try to create clarity with the story that you have with your restaurant. And so that's why, we've been successful with our, clients that we've shared, Jared. And, I think that kind of duo is helpful. So finding, accountant and a tax person that kind of help, it's a really great balance that's there. So again, I'm Derek White, principal at Withum. I'm just going to probably do tax and audit and accounting work in this industry. Jared Feldman of Jared Feldman Consulting is at his client base, primarily California, some Hawaii, amongst other places, but quite knowledgeable and with those nice clients that have 1 to 5, maybe even 10 units. That's a sweet spot for both of us in terms of our work. So we appreciate your time. I appreciate your time, Jared. Thanks for joining on this call.
Yeah, thank you so much for having me, Derek.
Yeah, thank you.
You've been listening to Withum's Taxing Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.withum.com for additional information. Send an email to info@withum.com or follow us on Facebook, Instagram, or Twitter @WithumCPA. Thank you for listening.